Jeremy's asking, you noticed the risk range for the 10-year note has been widening?
Yep.
Is this a function of volatility after the new leg of a breakout? And what does the widening range imply?
Well, it just implies that Treasury bond volatility is picking up. So that's called the MOVE Index. So again, actually, it's sad, but a lot of people that only watch CNBC because it's free or part of their cable cutting package or whatever it's going to be. This is called, the MOVE. So the MOVE, moving the MOVE.
Favorite chart.
Treasury bond volatility is called the MOVE Index. It was plus 20% last week. So when it goes up 20%, what do you think the risk range does? It widens. Mm-hmm. If the range was like this, it widens. Actually, what's happening now is that the range is going like this. Mm-hmm. So it's widening the wrong way, which happens 100% of the time when the cycle is obviously slowing. It was a much tougher call for us to make the quad 4 and Q4 call that we made on September the 27th than it is now. If you measure and map the economic data daily, like we do, vigilantly within the prism of our process, you would have to be willfully blind to not know that the economy is slowing, okay? And the profits are going negative year over year. That's why you're seeing the move, because the move actually is now predicting that the Fed isn't dovish enough. So if you think one rate cut of 25 basis points is enough, that's probably not right. And that's the point I'm trying to make. Where I'm concerned about being wrong is actually getting back in too early. I haven't done that yet, thank God. But again, that's what I'm worried about, and that's further down into cutting into my fishing time in late August.
Yeah, totally. Do you mind if we show them one of our favorite charts before we wrap up?
Yeah, before we say that, though, for people that will never subscribe, I want you to know this. Just because I said that, if you want to go back in late August and say, you said late August, I could change my mind anytime I want, all day long. All of our subscribers know it. We put it in print. We put it in vocal. We now have pictures, cartoons, videos, everything. So that's the whole point. Every single day you have a process, you execute on it, and we all reserve, unless we live in China, the inalienable right to change our mind as free market capitalists anytime, all right? For now, that's my best bet.
Yeah, totally. Did you want to wrap up with the chart? Is that it?
No, you do it.
Yeah, go to slide 72. Josephine, it's one of my favorite charts. If you don't fundamentally understand credit cycles, this is a phenomenal chart for you to review. There's so much information in this chart. What we're showing here on the x-axis is the MOVE Index Keith was just referencing, the Treasury Bond Market Volatility Index. On the y-axis, we're showing high-yield option-adjusted spreads, the annual average of those two indicators. And the size of the dot is calibrated to the leverage in the corporate non-financial sector. And what I mean by that, it's a ratio of GDP to effectively show how levered the corporate sector is. So what you see is that we're very late cycle currently in 2019. The MOVE Index, Treasury bond prior to what we've seen in the most recent 2 months, the MOVE Index was about as low as it could possibly get, and this is data going all the way back the last 30 years. With high yield spreads really just about as tight as they can potentially get at the bottom of any cycle, or at the top of any economic cycle, rather, bottom of a credit spread cycle. Once the move starts moving, it effectively means that the Federal Reserve, the market is effectively pricing in interest rate cuts by the Federal Reserve, and the faster the move moves out, the more the market doesn't believe the Fed's communication. It's effectively forcing the Fed to act. And at the same time, as high yield spreads are widening as they are currently up 74 basis points month over month, that's a real big signal to investors that the Fed is behind the curve with respect to policy easing. Yeah. And that's a real big signal. So if the Fed waits till September to cut, a lot of this could actually, these kind of trend bounces, they could really fade and dissipate and actually start to resume what we saw in May, throughout the rest of the summer. So that's the real big risk, is that these dots really, there's nowhere to go once the horse leaves the barn.
Yeah. So again, these are not unlike most of what you hear, read, see in old wall media broadly, is not fake news. These years happen, okay? So this year, 2016, happened to credit spreads. It also happened to earnings. They were broadly negative year over year, but it was isolated into 3 big sectors. So that happened. So again, credit spreads widened. You go up on the x-axis, and as Darius points, you moved out. This is where the dot is today. It's only moved up a bit, high yield spreads have, because everyone's, don't worry, the Fed's going to be good. But again, I digress. This year, 2000 happened, 2001, 2002. Oh no, you don't want to talk about Pluto. That's out there. Right? We don't have to make that call. In fact, I'd say that if this thing goes to here,
that's terrible,
which is a very conservative estimates, you're going to have wreckage beyond what you saw in May for a while here, and the Fed is going to have to do a lot more, to Darius's point, than what the market got excited about yesterday.
You know what the median peak to trough decline in for the average stock, the Russell 3000 in the U.S. equity index, was minus 38% at the lows of 2016. You know, we're not necessarily, again, we don't make targets. We're not calling for that. We're just saying if we go there, you know, December might actually look very favorable.
That's actually why, and again, it's not trying to be trite or to be cute. It's to be right. Like our call to get the hell out in 2015 of all the same things, high beta, small cap. You know, again, the average decline of a stock in the Russell 3000, if you didn't comprehend what Darius just said mathematically, that's what it means. The average decline in a stock was 38%. That means that there were stocks that were down 50, 60, 80%.
Yeah, totally.
Okay? So that's what if I said, well, my price target is at down 21%? I mean, I would have missed the last 17% of that average decline.
Totally.
Okay? So again, wake up humbly. Humbly. You know, again, God willing, 2 feet on the floor, 2 hands on the keyboard, every single day, recalibrate, reset. It's called Bayesian, okay? It's called a Bayesian inference process. Look it up. And every day, you have a better chance to improve your position. There's no better day than today, every single day to do that.